Hello and welcome, everybody. Andy here. Today, I would like to talk to you about a very interesting economic sort of development that's going on this year, last year, and this year, and it may be a comparison to how the economy has been performing in the past, and then how it could actually perform in the future. So I want to talk about the topic of reflation, which you don't see a lot of people talking about it. Basically, the reflation that we're talking about is becoming the next bullish narrative because the equity valuation is increasing and it's continuously outpacing earnings gains, and at least according to Goldman Sachs and all the other wealth fund groups who are actually publishing articles. Interest rates, gold, and commodity prices have increased in the past few months, which is not really surprising because of the narrative, the bullish narrative actually, that supports the rise in those sectors. But what is interesting is that this reflation narrative tends to resurface by Wall Street analysts. And whenever there is a need to explain the surge in commodity prices, people keep referring to reflation. Now, the most talked about investing strategy these days is not stuffing money in a mattress, basically. It's the reflation trade. The bet that the world economy will rebound very soon. Everybody's so positive about it, driving up interest rates and commodity prices. So what you see exactly in this chart, that the reflation trade lasted for about 2 years. It quickly failed as the economic growth returned to 2% growth along with inflation and interest rates. So as you can see, the oil and commodity prices have a very high correlation. And the critical reason is that the higher oil prices reduce the economic demand. And in consumption, when the consumption goes down, the demand for commodities in general also goes down. So therefore, if the commodity prices are to reflate, as you can see in this chart, this will depend on a more robust economic activity. So as you know, every time we had a reflation trade, basically the manufacturing and economic growth also changed. So the reflation trade hinges on a global resurgence of economic activity. Okay. Now, the topic also has a lot to do with the spending and the deficit that we have right now with Federal Reserve. If you just take a look at this chart here, one explanation for this is the surge in the federal expenditures since the end of 2022, stemming from the Inflation Reduction and the CHIPS Acts, right? So the second reason is that GDP was so grossly elevated from the $5 trillion in previous fiscal policies that the lag effect is taking longer than historical norm to resolve, as you can see in this chart. So the economists, they focus on the reflation trade. I think the right answer here should be whether the support for more substantial economic growth really exists in the markets. And I think this is the key question that people should ask themselves. And that's really the determining factor. So is really this reflation behind us, or are we going to experience that? Now, interest rates and inflation, they have ticked up recently, driving many investors into gold and commodities. But the surge in precious metals and commodities is more of a function of a speculative exuberance rather than an economic resurgence. Now, is the reflation really behind us? That is the key question. To understand that, we should really answer the question whether the stock market frenzy to buy anything that is going up has a spread from just a handful of stocks related to artificial intelligence to gold and digital currencies. As you know, artificial intelligence, AI, is also one of those investments that a lot of people are just crazily going into. And you see, if you follow the channel and you look at the different stocks that we analyze, you see some of these companies like Nvidia, for example, they are totally in a bubble. So gold, commodities, and interest rate surge corresponds with more robust economic growth, guys, beginning in the third quarter of last year, actually. So this economic growth charged up all the investors to put more and more money into it. And if you look at this next chart, because of the massive flood of monetary support from the government spending programs, you see a dramatic surge into the stock market. But now this monetary policy, as you can see here, is basically reversing. It's going downwards. And as far as the reflation trade is concerned, as the monetary impulse recedes, the economic growth will also recede. So in other words, as they make the money more and more expensive, basically economic growth will also slow down. And even if the economy continues to grow at 2 to 2.5% annually, the annual rate of change in growth will still continue to slow down, as you can see in this chart, which is basically showing you the reversion to the mean. So the most important thing here is to assume that the government will keep spending like drunken sailors, as you know. Maybe this chart actually says everything about it. But if they don't, the economic growth rate will slow even more quickly without increasing monetary spending. So they are. I feel sorry for the Federal Reserve, because if they do something, they're going to hurt the economy, and if they don't, they're going to hurt the economy. So they're really in a, rock in a tough place right now. It's important to remember that increasing debts and deficits do not elicit stronger long-term economic growth, for sure. And that maybe this debt to GDP ratio is also a great depiction of the same topic. So the reality should be unsurprising, as this is not the first time the government has gone all in for a reflation trade. This happened also in 2009, if you remember, after the post-financial crisis, guys. So maybe past could be a good lesson learned if you look at this chart. And as you can see, in 2009, after the financial crisis and the recession, government and the Federal Reserve engaged in various monetary and fiscal supports to repair the economy. But the economy initially recovered from the recessionary lows in inflation, as you can see here, and the economic growth and the interest rates combined subdued despite ongoing interventions. So the economy actually went through the same process before as we had post-COVID. Okay, that's because debt and artificially low interest rates lead to malinvestments, which is a big topic to talk about, which acts as a wealth transfer mechanism from the middle class to the wealthy. I think that's another beautiful topic, how the middle class basically fail to invest in correct stocks, and they have the gambling mindset, versus the wealthy who actually invest in long-term and good assets. Now, that chart, maybe this is also a great depiction of inflation-adjusted household equity ownership by brackets. As you can see, the top 1% as opposed to the top 99%, as opposed to the bottom 50% who fail to show, right? So basically, point of my story here is, guys, that the new topic of reflation and actually monitoring the gold and precious metals and commodity prices plays a very important role for the future of equities, and a bullish narrative on reflation could once again find future disappointment, but the answer basically is going to be found in the economics of debt and poor policy choices that depends on the governments and how the governments continue spending. So I just wanted to share this video with you guys so that you have a clear understanding of how the economy functions and what you should be expecting. Like I have always said before, you will see within the next 2 months, you will see Federal Reserve telling the market that they are not going to cut rates. The market is probably going to react with sell-offs. However, if you have blue chip stocks with long-term visions, do not sell them, because you'll be missing on a lot. And if you just follow this channel, I'm going to provide you with a lot of good companies and good blue chip companies for long-term investments, and potentially also small cyclicals for those who are interested in quick wins.